Okay, so welcome again. In this case, we are closing the first day of the event with Wesley Gray. Wesley Gray does not require introduction, but anyways, I want to just say a few lines because it's for me, it's one of the most important speakers in this event. And he's the founder of Alpha Architect. They have this mission in the company, in this asset management company, that this idea of empowering investors through education, so that they write tons of papers, investigation papers. He has written a number of books. He has been teaching also in the university as a professor. So he's one of the greatest minds regarding investments and how to put it in practice for investors. So in this case, I don't want to brag here. I'm just gonna give a pass to Wes, and I hope you enjoy as I'm gonna do. Okay, Wes, hello. How's it going?
All right, appreciate it, Ivan. Thanks for the introduction. And so the topic of this conversation will be what it says here. Factor investing is simple, but not easy. And to Ivan's point, even though we've been doing this a long time and a lot of times people can make quant investing extremely complicated, the intent of this presentation is actually to simplify our understanding and to hopefully give you a basic framework of how to make decisions, not just as a factor investor, but as an investor in general. So without further ado, let's kick it off here. So first, I want to give you a quick introduction to our firm and how the heck we got started. So basically what happened is I've been writing a blog for a long time, and I'd always been into investor education. Well, you never know who reads your blog. And in our case, there was a billionaire that was reading our blog 10 years ago. And he basically said, hey, can you help me? I've got all these hedge fund managers. They've, killed me in 2008. I need to do something different. And I don't like the current approach that I'm on. And, me as at the time, a professor and entrepreneur, I was like, well, hey, anytime a billionaire reaches out, you probably want to help them. And the goal for this particular investor that essentially helped start our business is we learned from them that really what people want these days is things that are different, things that are transparent so you can understand them, and then finally things that are affordable. The days of hedge funds where things are, they're a little bit different, but they're totally opaque and way too expensive, that just doesn't seem like a good way forward. And that's, in a long story short, what led us to factor investing. So the topic of this conversation will be, what is this factor investing thing I keep talking about? Next question will be, are these factors dead? As you'll see, these things don't work all the time. That's for certain. Third question will be, well, why did these factors work in the past? And then finally, will these factors work in the future, which is really what we all care about, right? So first, what is factor investing? Well, quick background is I have not always been a factor investor. In fact, for basically the first half of my career being in the markets, I was a hardcore stock picker, right? So from about probably 98 to 2008, I was all about the old school value investing of Ben Graham and Warren Buffett, trying to pick undervalued securities, which I liken to essentially beating your head against the pole and trying to make something happen. And a lot of times it just doesn't happen, right? At least that was my experience. So I took that experience to grad school where I was at the PhD program there at the University of Chicago. And I still thought that I could be Wes, the stock picker. But unfortunately, I ran into this gentleman named Eugene Fama, who was my advisor, and he convinced me otherwise. And through that process, I essentially moved from being a stock picker to being a more systematic investor. I'm not a pure index person, but I do believe that using systems to implement your stock picking ideas, at least in my case, is a lot safer than doing what I used to do here on the left, which is basically beat my head against the wall and try way too hard. So factor investing is a great solution, in my opinion, to stock picking systematically. And the best way to describe it, if you're unfamiliar with the concept, is a Moneyball concept. So at least here in America, I don't know, it's probably 20, 30 years ago, the Oakland A's had no money and the New York Yankees had a ton of money. So New York Yankees would go hire scouts and, all these people that could help them identify good baseball players. But the Oakland A's, they didn't have all that money. So they had to sit back and think, is there a more efficient way to pick these baseball players than hiring hundreds of people to go scout and, check them out all day long? And it turns out there is. What the Oakland A's found out is you can simply use data associated with these different baseball players to map between their characteristics and their future risk and reward. So I have some examples here. There aren't the actual examples used, but the concept would be like, what's your batting average? How many home runs did you hit? What's your stolen bases, etc. We can use those characteristics of these baseball players and help predict future outcomes. And that's a lot more efficient than, again, doing what the New York Yankees were doing, where they would just hire a staff of 200 people to go talk to all these people, right? So the Oakland A's essentially, it's called moneyballing. They moneyballed baseball. Factor investing is the exact same idea, but applied in a stock market context, right? Where our baseball players are basically stocks. And we're going to look at the underlying characteristics of the securities. Some examples over here on the right might be market cap or the size, price to earnings would be like the value, return on assets might be the quality metric. And there's, hundreds of other metrics you could use. But the basic idea is factor investors are going to try to look at the characteristics of these underlying securities and then map those to predictions about future risk and reward characteristics that we may or may not like. And again, the argument is this is a lot more efficient than beating your head against the wall and hiring hundreds of analysts to try to pick these securities when it turns out that just using the data works pretty well and it's a lot lower cost. So essentially, a way to summarize what is factor investing to me, it's basically an efficient way to actively invest, right? We're still going to try to beat the market, do unique things, but we're going to do so with a computer as opposed to a person trying to pick these things all day long, right? And what's really nice about factors is because it's such an efficient mechanism for picking stocks and building portfolios, it will allow us to deliver lower fees, more tax efficiency, and more transparency to our investor base, which, again, how we got started was a billionaire reached out and said, that's what we want. Can you facilitate? And so I think the market's moving that way, and factors are a great way to build a business to be able to facilitate these demands from clients. So again, what is factor investing? It's Moneyball for finance, and it's an efficient way to actively invest. The next question is, are factors dead? Well, this chart right here is a picture of just the past 10 years. I haven't even updated it. It would be even worse if I updated it for the past 4 or 5 months. But this is the performance of a portfolio that is long, cheap stocks and short, expensive stocks, i.e. the value premium. And what you notice is that value investors, or those that pick these cheap stocks versus the exciting, expensive stocks, have gotten absolutely destroyed. And value as a factor surely looks dead to me because people have lost over half their money had they been long these stocks and short the more expensive ones. So are these value investors just crazy, or what the heck are they thinking? Well, let's dig in a little bit more. So first off, why would anyone want to buy these value stocks in the first place, right? This chart up here is not very pretty and doesn't convey a great story. Why were these people doing this? Well, this is the long-term data on the value factor, where the blue line is a very simple strategy. It's called FFVal, which is Fama French value, which every year all it does is buy the 10% cheapest stocks on book to market. right? So a very generic value strategy. And then the SP 500 is obviously the broad US market. If I was smart, I could have built one for the Spanish market, but you guys don't have as much data that I can access going back 100 years. The main point of this chart, though, is that over the ultra long term, this is around 90, 100 years, value outperforms the market over the long haul. And again, if you look here on the far right, clearly in the short run hasn't done very well, but the reason people like it is because of this long-term outperformance. And really the mantra that these charts tell folks is just buy cheap stocks. But of course, the question that a lot of people have nowadays is, well, that's pretty simple, and is it maybe too easy? So let's dig into that. And well, first, let me just highlight numerically just how bad it's been. So what this chart does here is the x-axis is time, and the y-axis here is the 5-year relative performance to the generic stock market. And it's the 5-year rolling compound annual growth rates, right? So if you're below this line, for example, some of these blue elements here are at around negative 10%. That means that you underperform the generic benchmark by 10% per year for 5 years, i.e., that's pretty terrible. And you'll see over here in recent memory, value as a strategy has been in the penalty box for a long time now. And of course, well, why is this, right? And the common narrative, at least with respect to this value concept, is that, well, the reason it's like that is because in the old days it worked because you had all these idiot stock pickers like the gunslingers who would, throw money around and make bad decisions. There was just too many dummies out there, as represented here on the left. But nowadays, everyone's got a PhD. Everyone's got supercomputers. So everyone is like Jim Simons, who, if you're unfamiliar with, he started Rentec, which is a firm that essentially prints money, right? They make 100% a year for past 20 or 30 years. And so the argument is all these additional brains and supercomputers coming online, they've led to this poor performance and value, because how could something as simple as just buying the 10% cheapest stocks work, right? That's crazy. All the brains have eliminated that former higher return that we used to see. The problem with that argument is we always got to remember that correlation does not imply causation, right? So it's certainly the case that the uptick in brains and computing power has gone up a lot recently, and value performance has gone down. But the problem is when we look at the long-term components of value versus the market, it underperforms over long periods of time all the time, unfortunately, right? So if we wanted to believe that this was a story about brains killing performance, we would then need to make a cause argument here, and we'd have to look at every single one of these red circles and try to understand, well, why did all of a sudden the brains destroy the performance, right? And so clearly it's probably not brains and supercomputers that kill the value premium. There's probably something else going on here. And we want to understand what that might be. So long story short, more brains does not seem to imply poor performance. It does recently, but it hasn't historically over time. So are factors dead? Possibly, but it's certainly not the case that it's because of excess brains. It could be, but it's unlikely, because we'd have to explain why this has happened throughout history. So let's ask the question, well, why did factors work then? We know they did work, at least historically. Well, I don't really know, but one of the great things about the world is that we have very smart people that do really great research. And if they do the best research, they get awarded the Nobel Prize. And in 2013, there were actually 3 people awarded the Nobel Prize in economics, 2 of which are shown here. And they were given the Nobel Prize for trying to address this question of, why do markets work? How do they work? And on one hand, you had Eugene Fama, who's, again, my old advisor. And his whole thing is markets are efficient. And we'll talk about what that means a little bit more, but essentially means you can't beat the market. Like market prices reflect the underlying risk, the underlying fundamentals. There's no way to get around that. But of course, that same year was someone who's equally as intelligent as Professor Fama, Bob Shiller. He was awarded a Nobel Prize for saying that I don't think markets work like that. In fact, I think they're the opposite, because have you ever met people? People are absolutely crazy. So how in the heck could a market be efficient, and how could prices equal fundamentals all the time, when if you hang out and talk to anyone out in society, you really realize they're crazy, right? Like, is Tesla really worth, the valuation of every single car company and every single, airline company in the world? Maybe, but maybe it could also be a sentiment-driven argument, right? And I'm not taking a stake on the Tesla thing here. That's just an example. But the main idea is that 2 Nobel Prize winners tried to explain this question of how markets work, and they got there via totally opposite means, right? So long story short, the Nobel Prize does not mean you have the answer to how markets work, because they actually say the opposite answer, which is great. Where does that put us? Well, I think actually when you combine the insights of these gentlemen, you actually do get the right answer, or maybe you get closer to the right answer. And so kind of what our simple formula for how markets work is the following. On the right here, you have the potential for excess return. And then on the left, you have the variables that contribute to that potential excess return. And the one is market risk. And this is the idea portrayed by Professor Fama, in the sense that, well, the reason you get extra return is because you're buying extra risk. But then you also have in the middle here, you have the Bob Shiller arguments associated with behavioral finance. Well, the reason you get the extra return for trying to, let's say, short some crazy stock that has huge sentiment is that you could die trying to short this stock before you're right. Right. And so a lot of times this risk is called career risk. So it's not that the prices are correct. It's just that it's really expensive and risky and difficult to actually exploit idiots in the marketplace. Right. And so the idea is that the reason when we make extra money in expectation, the reason we get to do that is because we have to take on these different risks out there. And the real formula for the marketplace over the long run is really no pain, no gain, right? You shouldn't expect to get extra returns unless you're doing something that is painful in some sense. And we'll talk about that a little bit more as we go through here. So first, let's talk about the simple definition of market efficiency. And that is this idea that prices reflect fundamental value. And let's walk through, well, why is that the case? The best way to explain this is, this is a $20 bill I threw on the pavement. I took a picture of it. So what does this have to do with market efficiency? Well, the efficient market hypothesis assumption is that, yes, we agree there are idiots out there in the marketplace, but these idiots can't affect prices, because if there's a $20 bill sitting on the ground, well, that's pretty easy. I'll just go pick that up, right? And so to the extent it's pretty easy and there's low arbitrage cost to exploiting kind of free money in the marketplace, that free money is not going to exist, right? Everyone's going to pick up the $20 bills, and you can never even imagine walking down the street and seeing free money lying around. And this is a simplified way to basically say that the reason prices equal fundamental value is because the market is very, very competitive. And if there's ever free money out there, people take it away, right? And again, the key assumption I want to highlight here is it assumes low arbitrage cost. So it assumes that picking up a $20 bill is actually costless. And if that were a true assumption, it is the case that efficient markets make sense on average. Prices should equal fundamental value in a competitive marketplace. However, the Bob Shiller argument is like, well, I think it's a little more complicated than that. Let's say there's a $20 bill on the ground, but what if there is a random grizzly bear who likes the smell of people, right? And it walks over there, it smells people smell on this $20 bill, and it grabs it in its mouth. So it's certainly the case that we should not see $20 bills hanging out on the ground. And it's even crazier that we should see $20 bills hanging out in grizzly bear mouths. However, the arbitragers out there who used to be able to just pick up the $20 bills for free, now there's an issue. They see this free money, they see this $20 bill, but they're like, wait a second, if I go grab that $20 bill to try to make prices efficient, I might die because this grizzly bear will eat me and spit me out the other way, right? And so now we have an assumption of high arbitrage cost. So the $20 bill that, let's say, I dropped on the ground because I was an idiot, prior in an efficient market, someone would have taken that. But now, because there's random noise in the marketplace, people do crazy stuff, grizzly bears show up, I'm not going to try to exploit the $20 bill anymore because of the cost, right? And so what the inefficient market or behavioral finance school of thought is that prices equal fundamental value kind of on average, but there's so much more noise out there than people give credit for, that we should actually pay attention to. And a lot of this noise is driven by the fact that competition doesn't lead to fundamental prices when it's really costly to try to exploit these, quote unquote, arbitrage opportunities. And we'll walk through those in a more applied context now. So first we'll talk about the efficient market risk component. Then we'll talk about this career risk component. Let's first talk about market risk and why that helps contribute to an expectation of getting to earn extra money. Now, this story is very simple. And again, it's so simple, we can put it on a napkin. And I stole this from someone on Twitter who said I could use it because I just thought it was a great way to explain market efficiency, right? And what we have here on this napkin is on the x-axis, we have risk. On the y-axis, we have return. And if you are in the low risk, high return, you're in the fraud bucket, right? So this is the Bernie Madoff land you want to avoid. So if someone tells you that this has no risk and a ton of return, the efficient market hypothesis would signal rightly that we should run away, right? Because this is probably not true. And that's just because markets are pretty efficient and competitive. Similarly, in the far high risk, low return, this would be the stupid bucket. So let's say you have a cousin who's got a VC idea on a new Bitcoin startup out of his garage. That sounds exciting, but that also sounds like a ton of risk for probably not a lot of return, right? So these are things that people do all the time that just don't make any sense, like giving their cousin some money to do a crazy tech startup where they have no chance of success. We want to avoid that too. The market efficiency hypothesis suggests we want to stay either in the low risk, low return, that's believable, or if we want to earn higher returns, well, guess what? We have to take higher risk, right? So this is certainly one component of trying to understand why do you get to earn extra return is you got to take higher risk. However, we don't think this explains the entire story, right? This is just the Eugene Fama argument of the story. The other story relates to behavioral finance and the Bob Schiller school of camp, and that runs through what we call the career risk channel. And this one's a little more complicated, but I'll try to explain it. So this is analysis or summary of a paper called The Limits of Arbitrage by Andre Seifer and Robert Vishney, which is really good. I highly recommend everyone read it. But basically what their model does is the following. They say, okay, you efficient market people are crazy because what you don't realize is that fund managers and investors manage other people's money. And with that dynamic, I'm going to give you some insights on how it actually works. So let's say we are at this far left part on the graph, the current value, and we are at t equals 0. So this is today. And let's say in the long run, whatever that means, let's say 10 years from now, that we know that this stock is worth 2 times, right? And let's say that we're God or someone who knows the future. So we'll just assume that this is actually true. In the short run, like maybe that's the next quarter, the next year, the next 5 years, whatever seems relevant to your mind, it could get a lot better. Like the stock could move towards fundamental value, but the problem is it could also get worse before it finally gets better. And the challenge here is that if you manage other people's money, and even though you as the investor know that in the long run this is a great decision, the problem is if the market got crazier before it got better, and you post that you went from $100 to $50, and you try to explain to your investors that, listen, I know everything about the world. I'm amazing. Don't fire me. Just trust me. I'm going to get your money back. Those investors are going to be like, you know what? This person's an idiot. They pull out the money, and now this fund manager is out of business, right? So this is the concept of career risk. And why does that matter? Well, now if this investor identifies this career risk problem, they might sit back here and think, you know what? Yeah, that stock is way undervalued. But if I do that, it's so volatile, it has so much potential to deviate from the benchmark, I could lose my whole business. So I'm just not going to do that. That's for someone else to deal with. It's too much career risk, right? I'd be much better served by just taking small bets around the benchmark, and we'll be a lot happier, and our business will keep going, right? Long story short, arbitraging long-term kind of like mispricings like value or momentum or what have you, they a lot of times require the investor to do trades where they might be right in the long run, but in the short run, this can be extremely painful, and they could lose their business. So just because it looks like there's free money, if you manage other people's money, you quickly realize that it's not free money, because people hate underperforming in the short run. Now, how can we investigate this concept and how important it is in the real financial market? Well, we actually did a study where we just pretended that we would know the future perfectly. And we can do this because we know the data of the last 100 years, and we can pretend we're God, and we can create a portfolio that starts in 1927 and just cheat, right? We can look ahead 5 years and just do a strategy that today would look ahead 5 years and invest in the stocks that we know are going to be the top 10% winners. And then we can analyze the performance of this portfolio. Well, not surprisingly, if you do this so-called God portfolio, you triple the stock market returns, right? So the market over the past 90 some odd years is around 10%, at least in the United States. And if you have this perfect strategy that every 5 years buys the look-ahead winners, it makes 3 times that much. Well, that shouldn't be too surprising, right? If you're a really, really good, perfect long-term investor, you're going to beat the market. But this next slide is what is crazy. So this is the drawdown profile of the perfect investor, God, and then the S&P. And what you notice is that even a portfolio that on purpose owns the 10% best performing stocks, this portfolio in live implementation has plenty of times to lose tons of money and look totally stupid and get God fired. And that should be scary, right? Because even the perfect active investor has plenty of chances to lose and have their clients pull the money from them, right? And this was something that was very, very surprising to us, and not very comforting either, but also just emphasize that this career risk problem is a real thing. So that's, again, hypothetical. Let's look in practice. Where have we seen this? Well, the number one case study would probably be Warren Buffett on the stock picking side. And why do I say that? Well, we're kind of in a deja vu moment at this point, but this right here on the left is a 9-month time period where the black line represents Berkshire Hathaway, which is Warren Buffett's essentially like his investment company. And in a 9-month period in late 90s, his fund was down almost 40%. Meanwhile, the triple Qs, which essentially represent like a technology benchmark, which everyone was paying attention to, which is kind of like today, where everyone's paying attention to triple Qs, the big mega cap tech, this thing was up 110%. So in a 9-month period, he underperformed what everyone thought was the benchmark by 150 percentage points. Everyone said that Warren Buffett was dead. He's a total idiot, etc. And again, this is the best investor of all time over the long haul. And everyone thought that he was an idiot. Again, he went to win over the next 10 years by, leaps and bounds. But in this period, everyone thought he was a loser. And had he been managing other people's money, where people could have taken their money out of Berkshire Hathaway, almost certainly he would have lost his entire business, right? Because if you underperformed by 150% trying to be a disciplined value investor, that's unlikely to be able to do that, right? No one's going to believe that you can come back, right? Because tech is so much better, value investing is for losers, etc. So again, that's the stock picking version of being a value investor in particular. And then we can also talk about being the factor equivalent. And I already highlighted this chart earlier, but again, anytime these blue marks are below the main line here, that means on a look back 5-year period, they underperformed on an annualized basis by that amount, right? So clearly the main reason people do value as a factor is you have a lot of opportunity to be above this line. But again, from a career risk standpoint, it's very difficult to own the top 10% cheapest stocks, because there's every single time you were in one of these red circles right here, you would definitely have gotten fired by anyone who had hired you to manage their money, because 5 years of underperformance is ridiculous. And no one will allow you to stick to a strategy that underperforms. Even though over the long haul, we all know that this strategy is probably a great strategy, right? So it's this career risk problem that's a real issue. So factors work for a reason. They're painful, right? Just like Warren Buffett, he's really rich for a reason. He does a lot of stuff that's actually really painful in reality. So again, why did factors work? We think that the reason they work is because they proxy these different things that we can do. If they worked in the past, it's because they proxy for market and career risk that are just hard to exploit and stick to. And if something's hard to do, you should get extra return. Otherwise, that wouldn't be very fair from a competitive marketplace standpoint. So the $1 million question we'll end with here is, will factors work in the future? And to answer this question, we have to go back to the fundamentals of trying to understand what we just described. Well, what drives risk and reward payoffs in general? That's how we will know if factors will work. And so if you believe in this theory and hypothesis of the world I've presented here, where the reason over the long haul you get to earn extra return is because you take on additional market risk and you do weird, crazy stuff that no one else wants to do, i.e. career risk, these two are buckets here, kind of the sources of your excess return. So to the extent you believe this, and this seems like a reasonable hypothesis about how markets work, which I think does, because this is kind of what the Nobel Prize winners have found. The real question is, will factors work in the future? Assuming that factors like proxy for risk and career risk issues, the real question would be, why wouldn't factors, if they are risky and if they are really hard to stick to, not work in the future? It would be an incredible world where something that's really risky and really painful to do doesn't make and earn higher returns in the future, because that would mean that markets are not competitive at all and they're just fundamentally flawed. And frankly, I just don't believe that. So I do think factors will work, but it's not because they're money trees. It's because of the underlying characteristics of what you have to do when you are a factor investor. And what I always like to tell people is when you look at the 100-year chart of some factor system or some systematic strategy where it looks so much higher than like an index, it's very easy to be like, oh yeah, well, I'll do that. But what people don't realize is that in the short run, this is your reality, right? There's always a narrative. There's always a story about why something doesn't work, why your idea is stupid, why, things are different this time. But the main thing I like to highlight is all investing is really simple, but just not easy. And I'll end with that. Ivan, you got any questions for me? Oop, I think you're on mute.
That's it.
There you go.
Excellent. Okay, Wes, it's really, this is super interesting. I have a couple of questions for you, but I'm going to ask you something first, just a quick one. That, what you are saying is super interesting. In this, if you want to exploit the career risk, for instance, it would be at the expense of a great pain, you said.
Yes.
So from an investor standpoint, do you think that investing in a factor investment fund or ETF would be better, since the interests of the investor would be aligned with this idea of not necessarily beating the market at a great pain? So do you think that factor investor would help investors to navigate better the investments than, for instance, hedge funds that they know and they want to look for this pain, for instance, many of them, active?
Yeah, no, for sure. So all you got to do is if you want to identify some investment that you think is going to potentially generate extra return, you got to ask the basic question is, okay, is whatever this fund doing, is it loading up on additional market risk at some level? If it is, that's actually good, right? If you want to perform a long haul, you got to take some risk. And then on the career risk side, to your point, like let's look at the construction. If this fund basically just tracks, the passive index, well, there's not a lot of career risk. So it's probably not going to, even though it may be called some factor fund, if it's not doing something different, which could lead to the career risk pain, how is it ever going to generate any excess return there, right? So this is really a simple mathematical equation to just explain how you would assess really any investment to try to determine if it's going to earn you extra return or not. And that applies to factors or bonds or pretty much anything.
Totally. Okay, and then I got a question here from the audience that is, okay, would you use a screener, a free screener to rank the markets, or how, because in this case, the particular investors, how can do that? If they want to copy, they want to clone models, so how would you think they should do?
Yeah, there's a lot of ways you can do it. There is screeners out there and tools where technically you could DIY that. Do it yourself, and we even provide some access to that, and that's great. And there are people that can do that. It's just the issue with doing it yourself is manage your portfolio, putting together in a smart, sensible way, and making sure you stick with the program. Some people can do that, but to the extent that you can go out there and purchase some strategy that is not too expensive. A lot of people decide that, well, I could DIY it, but I can also, there's all these great funds out there that basically already do this, and they're not, exorbitantly expensive. That might be a better way as well, or another option to people. So there's, a lot of ways you can skin a cat, from DIY all the way to just outsourcing it to, ETFs and I guess maybe mutual funds or UCITS or other vehicles out there.
Sure. Okay, and the last question, Wes, this one is super nice because it's super clear, super simple. He says, what would you recommend me study if I want to understand your speech better, along with this quant investing philosophy? Some box recommendations and stuff?
Yeah, so some of the, I guess, best books is, obviously we have books out there that we actually find interesting, but we're also really biased because we wrote them. So they're probably no good. But some other books out there that other people write that I find really great is Jim O'Shaughnessy has a great book called What Works on Wall Street. That's a really good in-depth book that talks about a lot of this factor investing and, like it says, what works on Wall Street. Then another really good book, it's a more updated one that I find really good by Larry Swedroe and Andrew Birkin, who's actually a Caltech PhD, if you can believe it. I think physics, so a pretty smart guy, is Your Complete Guide to Factor Investing. And I like that one because Jim's book, What Works on Wall Street, is about, I don't know, that thick.
Yeah,
so that's a good one. You really want to go deep. But the other, Your Complete Guide to Factor Investing, is about that thick. And it does a good summary, I think, of factor investing, where you can get kind of the big picture in less than 200 pages. So those are two recommendations, aside from reading blogs and all these sort of things.
Well, I'm going to say that additionally, on top of that, they should also read your book that you have not said it, but the Quantitative Value book is a marvelous book. And it also, it's this idea of understanding the different strategies, and all the study that you have done is really cool. And this one is wrote along with Tobias Carlyle, and it's a really good book, actually, very, very good. And also your blog. This is an excellent way to learn. So thank you, Wes. It's been a pleasure to have you on. Now we are closing the first day of the event, and we will see in the roundtable. So it'll be a pleasure.
Excellent. Look forward to it, Ivan, and good luck with the rest of the conference.
Okay, so excellent, Wes. So we keep in touch. Bye-bye. Thank you.